ahead and select the chat button at the very bottom of the GoToMeeting screen, and you can submit questions during the presentations to my colleague Liliana Tangwell, and she'll be chatting with you during the presentations. As I mentioned earlier, that we have your microphones muted at this point. We are recording the webinar, and it will be posted to World Council's website. I'd like to now introduce our presenters and get started this morning. First, we have with us Ms. Holly Skyfe. And Professor Skyfe is a chartered accountant, has her master's and doctoral degree in accounting. She's a professor of accounting here at the University of Wisconsin with a research focus on financial reporting. She serves on the Standards Advisory Council of the International Accounting Standards Board, and in fact, just yesterday got back from New York, where she was one of the key presenters at the IASB, the International Accounting Standard Board's roundtable in New York. So we're very pleased to have Holly with us this morning as an expert and with the latest and greatest information. Following Holly's presentation will be Gary Rogers. Gary is the Vice President of Financial Policy at the Credit Union Central of Canada. He's a chartered accountant himself. He's been with Credit Union Central of Canada for approximately 11 years, and prior to that, he was worked in public accounting, where he spent roughly 10 years with Deloitte and Touche. Gary is leading the project for credit unions throughout Canada on compliance with international financial reporting standards. And our final presenter is Ellie Zognani, and she is the Chief Executive Officer of Fulm Savings House, which is the credit union system in Macedonia. She is a former WOCCU Young Credit Union professional, and she has her master's degree in business administration from Sheffield University in the UK. And most noteworthy is that although it is a very small credit union system in Macedonia, when they learned of the importance of international financial reporting standards, they were one of the first credit union systems around the globe to take a strong stance towards adoption. So without further ado, I'll go ahead and turn the microphone and the screen over to Professor Skyfe. Thank you.
Thank you, Dave, and thank you for inviting me today to this panel presentation. My objective today is to provide an overview of the financial reporting standard setting process, and as part of that, introduce you to the organizations and bodies that are involved in promulgating IFRS. As Dave mentioned to you, I'm a professor at the University of Wisconsin-Madison. I do serve on the Standards Advisory Council of the ISB, which is a component of the body that puts forth the standards, and my comments today are based on my own experiences reviewing those standards, researching those standards, and participating in both formal and informal discussions about the impact of IFRS. To begin with, I think it's important to note that the demand for financial information comes from two key sources. There are the internal decision makers who have to make decisions about the day-to-day operations of an entity, and they demand financial information to assess performance and make decisions about those operations. In particular, when we look at credit unions, there are some key performance indicators, such as the allowance for loan losses or effective financial structure ratios, other types of measures that fundamentally are taking a look at the financial statements and putting together criteria for which to judge performance and operations. That information is also quite important to external decision makers, those individuals who demand financial information to make resource allocation decisions or to monitor a company's operations. So if we think about a credit union, we are looking at the external decision maker being perhaps those regulators who have as their goal the monitoring of credit unions to meet their objectives and constitutions. So the stakeholders involved in the financial reporting process are quite diverse. The real birth of a set of common financial reporting standards came as a result of an interest in the public capital markets for comparable financial information across borders. The stakeholders in a public capital market include the equity shareholders themselves, creditors, analysts, institutional investors, tax authorities, and market regulators. But for credit unions, we can actually believe that there's great value in providing financial information that is useful to credit union members as well as the regulators. So the stakeholder base is quite diverse when we think about financial statements prepared under IFRS. But in the end, the goal is to make sure that there are adequate information flows in the marketplace across all interested parties. When we think about those financial statements, we need to begin with an idea of what are the characteristics that manifest in high-quality financial reporting. And as you can see on this slide, there are three key characteristics. Financial statement users need to have relevant financial information, information that's timely and pertinent to their decision making. They need to have reliable financial information, or in other words, financial information that has economic events appropriately represented. We also refer to this as representational faithfulness. Those are some key words that are found in the conceptual framework of the International Accounting Standards Board. And again, the last criteria is this notion of comparability. It's so important to have financial information that can be compared not only across firms, but also across time if you're thinking about a company who is consistently reporting financial information to its stakeholders. I point out a concept release that was issued by the U.S. Securities and Exchange Commission because this concept release identifies the fact that high-quality financial reporting is not only contingent on having high-quality financial reporting standards, but also involves other mechanisms that contribute to the development of useful financial information. Those being high-quality audit standards, an audit profession, and then the oversight of the financial reporting process. Today's presentation is focused primarily on the notion of the standards that credit unions could follow in preparing their financial statements. But it is a collection of individuals and mechanisms that in the end work together to promote, again, useful information flows. So the thing that becomes important for us when we think about a set of financial statements is to consider that there are really several components that we need to remember standards address. One is what do financial statements consist of? What are the elements? And of those elements, we've moved towards having institutions that provide not only balance sheets and income statements, but also statements of equity or ownership, as well as statements of cash flows. Measurement standards are the standards that define what will be recognized on the financial statements and what value will be placed on those assets, liabilities, and ownership claims. Disclosure standards are those standards that relate to providing additional information that's useful in understanding the measurement and recognition rules. And across this set of components, one could argue that the disclosure standards are those standards that distinguish high-quality reporting from other reporting in the terms of the small SME project that Dave mentioned earlier, because the SME project is the project that has noted that disclosure standards can be burdensome for those entities that do not have a broad stakeholder base. And there are things to consider in terms of voluntary disclosure as well. So some background on IFRS. And I have tried to put into my slides the definitions of the acronyms used, but we'll say that the acronyms are representative of the reporting environment. And as it turns out, one of the things that was discussed at the round table that I attended on Tuesday in New York City was the branding of the IFRS name and the consistency within use of IFRS so that the Constitution will eventually have less acronyms for us to deal with. So background. The International Accounting Standards Committee was the original body that was formed in 1973 to address the need for a common set of financial reporting standards. At that time, the organization was made up of part-time members, volunteers. There wasn't a formal process by which the standards were being developed. And for that reason, there was quite a bit of scrutiny regarding the standards and their ability to really generate useful financial statements around the world. The common criticism was that the standards that were initially enacted by the ISC allowed too many choices in those measurement standards and did not require enough disclosure practices to be revealed. Over time, the demand for a common set of financial reporting standards grew to the point that in 1997, a working party was organized to address the need, and as a result, a new constitution was formed and put into play what currently exists as the body that promulgates IFRS, the International Accounting Standards Board. The board operates under the International Accounting Standards Committee Foundation, which is a nonprofit corporation and is committed to producing standards that can be used around the world. So let's take a look at the organizational structure. It's important to remember that in order to have a set of financial reporting standards that people can rely upon in making their decisions, there needs to be independence in that process. And to that extent, the current organizational structure of the ISB is intended to promote independence, accountability, and transparency in the process of standard setting. You can see that the key component here, outlined in red, is the board. The board is made up of individuals that represent user groups, preparers, auditors, and other bodies, individuals concerned with external financial reporting. Okay. So the board has geographical representation as well as a diverse expertise. The ISC Foundation, which if in fact the Constitution is amended as currently being discussed, would become the IFRS Foundation, is made up of trustees who again are providing oversight and input into the board, but allowing the board to act independently in the standard setting process. As the board, the ISC Foundation is geographically diverse. Currently, the proposal to amend the Constitution would include recognizing Africa and South America formally on the board, the foundation, and currently there are membership commitments from the European Union, North America, and the Asia, Oceania area of the world. The council that I serve on, the Standards Advisory Council, again is a group that is quite diverse, all of whom have an interest in the production and dissemination of high-quality financial reporting. The Standards Advisory Council provides input to the board on the agenda and the work program. We operate at a very high level, so not dealing with the details of the standard, but rather how are the standards being embraced and how might the set of standards be improved in order for entities worldwide to accept and implement those standards. Okay. Working groups, again, are focused on major agenda projects. They're more specific in nature. And IFRA, the International Financial Reporting Interpretations Committee, is responsible for giving additional guidance to the implementation of the standards. One of the key improvements to the organizational structure came about in February as the monitoring board was put into place. This board was viewed to be necessary to improve the accountability and transparency of the standard setting process and provide oversight over the trustees. So this organizational structure has evolved over time and is critical to, again, the development of a set of standards that users can rely upon when judging the quality of financial statements. Okay. So I've kind of worked through this, so I'll move on to the next slide. Currently, the trustees are engaged in the required 5-year constitutional review. The first phase of the project was completed earlier this year, and again, as a result, the monitoring board went into place. Currently, the second stage is addressing these key elements of the Constitution, perhaps the most important of which is the ISB's agenda setting process. What projects come to the table? How are those projects developed? And what are the timelines in terms of the ultimate issuance of the standard? Part of the concern about the agenda has been driven by the recent issues in the capital markets that required some fast action by standard setters around the world to address some of the accounting for financial instruments. And going forward, it would be noted that perhaps a defined process would be useful in determining if there are or is a need in the future for any fast-track due process reviews. Another key change proposed to the Constitution is, again, a clarification and protection of the IFRS brand name. There has been concern worldwide that entities state they are reporting under international financial reporting standards when in fact they're not complying with those standards. It is an important issue that needs to be addressed in order to, again, give assurance to those reading financial statements that when they pick up a report that states preparation under IFRS, they can rely upon those statements as having done so. Otherwise, the other issues being debated currently is this notion of the geographical balance among the trustees, the length of terms for board members, and in order to increase the outreach of the boards and the trustees, the appointment of 2 vice chairmen that would again facilitate the support of IFRS worldwide. If interested, you can go to the ISB website. There is a document that is available. It is a call for comments, and you can download that document in PDF form and update yourself on the issues on the Constitution and make comment if so desired. I briefly want to highlight some of the major differences between IFRS and U.S. GAAP because of the notion that U.S. GAAP is one of the sets of standards that many entities are reporting under, and currently the U.S. is the largest country that has not fully embraced IFRS. Other countries have come on board, and as other panel members will speak to in just a bit, the recognition of IFRS has grown in strength worldwide. The U.S. is currently debating the allowance of international financial reporting standards for U.S. domestic issuers, meaning companies that are domiciled in the U.S. and are currently reporting under U.S. generally accepted accounting principles. The U.S. Securities and Exchange Commission allows foreign issuers the choice to use IFRS, but that choice has not been available for the U.S. domestic issuers. Thus the reason why I'm giving some brief overview of the differences between the 2 standards. This is not meant to be complete. It just highlights how, when we turn to looking at financial statements and comparability, how differences in the standards might impact those ratios and those analyses performed because comparable financial information is not being presented. One of the key things to note is that the philosophical approach of U.S. GAAP has tended to take a rules-based approach in that there are so-called bright lines that define how a standard should be implemented. IFRS is thought to be based more on principles, and as a consequence, many more judgments go into the standard setting process. Although I will say that under U.S. GAAP, there are a lot of judgments as well. These are just, again, kind of a broad sweep of the differences that others have talked about. The conceptual framework is of utmost importance when we think of the development of high-quality financial statements. In order to set standards, the standard setters need a framework that lays out the objectives of financial reporting and the characteristics of financial information. Currently, the Financial Accounting Standards Board in the U.S. and the ISB are working on a common conceptual framework that in the end would ultimately result in similar accounting standards or standard setters that are standards that some say are converged. One of the key issues facing IFRS is the regulation and oversight. Unlike the U.S., where the Securities and Exchange Commission, under the authority of the Congress, has the right to monitor and have input into the standard setting process, there are the individual countries' market regulators, auditing standards, and codification that have to be dealt with when one thinks about the oversight over IFRS. This is one of the reasons why the Constitution becomes so important and the organizational structure so important, to guarantee that there's independence in the standard setting process, while at the same time the monitoring board is recognizing key public organizations that would have a role in the oversight and regulation of IFRS. So the next couple of slides, and I'll just be selective here, are trying to highlight different components of the financial statements and how the measurement rules might differ. One thing, I'm going to move to revaluing long-term assets because this is one that everyone might relate to. If a credit union owns their building, has some property, under U.S. GAAP, that standard does not allow the upward revaluation of assets. Under IFRS, the credit union would be able to upward revalue their building to recognize any increase in market value. Likewise, if we take a look at impairment of long-term assets, an important difference between U.S. GAAP and IFRS, so if we're talking about, again, how we account for long-term assets, under U.S. GAAP, once an asset has been impaired, reversals are not permitted. In contrast, under IFRS, once an asset's been impaired, if in fact the asset increases in value, that increase in value can be recognized in the financial statements. So these are very simple illustrations, but they highlight that the difference in the measurement rules will have an effect on companies' assets values, liability values, and operating performance measures that then create a difficulty in comparing those key ratios across borders. This is the goal then, to have one set of common financial reporting standards. Okay. So again, some have argued that there could be multiple sets of standards that continue worldwide. There could be two sets of standards. If we think of two sets, the conversation has tended to focus on IFRS and U.S. GAAP as being the standards that exist. But again, I think many individuals believe that one set of standards in the long run would be most beneficial. And I highlight here some of the efforts to converge U.S. GAAP with IFRS. Okay. One last note that I want to mention, as Dave indicated, currently IFRS for SMEs is not available for credit unions. I would guess it's probably related to those disclosure requirements, feeling that the disclosure requirements are necessary to provide transparency in what's happening within the credit union. But nevertheless, I do believe that this particular standard illustrates how the ISB is dedicated to addressing the reporting needs of all stakeholders worldwide. So unlike other sets of financial reporting standards that may be geared primarily for common stakeholders that are separate from the actual companies from which they invest in, the ISB has a much broader scope in that they are taken as their objective the development of standards that will meet the information needs of various stakeholder groups. So with that, Dave, I'll thank you again and welcome comments later.
Thank you so much, Holly, for providing us, I think, a great overview and understanding about what IFRS is, why it's important. We'll now move the presentation to something more at the credit union level about what does this mean from an implementation perspective, and I turn it over to my colleague, Gary Rogers.
Thanks very much, Dave. And I do want to say a word of thanks to WOCCU for offering this session today. WOCCU provides very valuable service to different credit union movements around the world in sharing information. And I think that this is one of those subjects that is highly technical and where we can benefit from the work that's been done in other jurisdictions as we make our own preparations in getting ready for IFRS. Today I'm pleased to talk
Gary,
to you about
if you want to go ahead and show the screen on your end.
Can you hear me, Dave?
Yes. We can't see your screen, though, if you want to bring that screen up on your end.
Okay, it's on my computer.
Okay. If you want to click on Show My Desktop.
I did. That is no longer showing. Can that command be sent to me again?
Okay, we will. Sorry, go ahead.
Okay, I now have a message saying I'm no longer the presenter. I now have a message saying show my screen. I have clicked on that. Can you see my desktop now?
It's all right now. Go ahead and bring up the presentation.
Can you see it now?
Yep, we're set.
Okay, super. So today, the purpose of my presentation isn't so much to talk about IFRS, but about the Canadian project and what we have been addressing here in Canada as we get ready and how we've approached it. IFRS will affect all Canadian credit unions. It
Muted.
Any differentiation between large or small credit unions. They must convert Canadian GAAP to IFRS for financial reporting purposes, and our commencement date is for fiscal years beginning on or after January 1, 2011. Our timeline is such that the full reporting is required for those fiscal year ends beginning January 1, 2011. But that set of financial statements must also include a comparative column for 2010. So data relating to this would have to be accumulated beginning in 2010. Also, the December 2009 financial statements would have to disclose key impacts of IFRS. And the year end that's already passed, so December 31st, 2008, also required some financial statement note disclosure that disclosed to readers that IFRS was coming, that the credit union is preparing for it, and a brief discussion about the types of impacts that might be expected. So how will the transition work? We will be required to recast our 2011 balance sheet as if IFRS always applied. There are certain grandfathering provisions in the transitional rules, IFRS 1, and the rules will be based on IFRS rules as they exist at the end of the first reporting period. So as Holly pointed out, the rules continue to change. That has created a moving target for us, which we have to keep in mind with our project. Not all the rules are fully in place that we will have to comply with in 2011. There will be opening transition adjustments required. We expect that those will impact capital directly. There are a number of choices and decisions to be made, and significantly more disclosure, both quantitative and qualitative. It's expected that the notes to our financial statements will increase by at least 50% over the disclosure that we prepare now. So what changes do we need to be prepared for? Well, identification of the differences between IFRS and Canadian GAAP. As Holly mentioned, more judgment will be required because IFRS is a principles-based framework. Fewer rules, less interpretive guidance, so more subjectivity involved. There are choices that can be made, but we recognize that some of those may be limited by regulators. We don't have full input from regulators yet as far as which choices will be acceptable and what might be limited. And as I mentioned, considerably more disclosure required. As we've taken a look at the expected impacts, we quickly synthesized those down to 7 key areas. And we also have prepared heat maps that highlight red, meaning extremely important or high impact, yellow, which would be less so, and green that we're already fully compliant with. The 7 key areas are identified on this slide, and the circles that you see, the red or the yellow, doesn't suggest that every credit union would be impacted in the same way. Each credit union will be different depending on their operations, the types of assets they hold, the types of employee benefits they offer. However, this is an indicator of where the most attention should be paid. We've segregated it into impact on assets, on capital, on income, on disclosure, and also on systems and process. As part of the project, we're also highlighting for credit unions that this is far more than an accounting exercise. In addition to impacts on internal controls and GL systems, of course there'll be the impacts on financial statements, but also accounting resources and capabilities have to be managed. How much capacity is there in-house in the credit union to manage this transition? How much needs to be acquired externally? Treasury and financial risk management needs to be considered. There are aspects of regulatory capital that have to be managed, discussed with regulators. The transition will affect budgeting and forecasts because the bottom line will change from the existing Canadian GAAP rules. There'll be impacts on income tax. Certainly communication with board members will be important. I think communication with the credit union members less so. Mergers and acquisitions will be affected in that the accounting treatment in some cases will be different under IFRS than under Canadian GAAP. There'll be impacts on mergers and acquisition performance metrics and also compensation plans. So let me just take a step back and talk a bit about the background to our project. In Canada, there are approximately 430 credit unions. They are grouped into 7 areas and own 7 provincial centrals. The centrals own Canadian Central, the National Trade Association. So you have 430 credit unions individually owning 7 provincial centrals and the 7 centrals owning Canadian Central. Those 430 credit unions are separated by up to 5,000 kilometers of distance. We have very large credit unions and some that are very small, some that have very complex operations and some that are very simple and straightforward, some that are well-resourced and staffed from an accounting and management perspective, others less so. So we have a wide variety of credit unions in the system and a wide variety of capabilities for managing this transition. Each credit union operates separately. It has its own chart of accounts, its own accounting system, its own data systems, its own auditors. So with that background, we have a very diverse membership. In 2007, extensive new disclosures were required for financial instruments, and those evolved Canadian GAAP a long way towards adherence to IFRS standards. This was a very complex set of standards. Credit unions tackled them independently, and it was a very difficult and time-consuming and costly exercise. Never again did want to have to go through that type of exercise independently. And really that drove them out of recent experience with financial instruments to talk about putting together a national IFRS readiness project. I think that had the conversion on financial instruments not taken place in 2007, we wouldn't have had the will and the push for a national IFRS project. One of the phrases that I use sometimes is that credit unions face a creeping crisis of complexity. They see it in rules that governments create for them, not just regulatory for their financial statements or capital, but other rules as well. There's a huge amount of complexity around IT, around human resources, around the products that they offer. So part of this creeping crisis of complexity is the ever-increasing requirements on accounting standards. And the National IFRS Readiness Project is intended to partly address that. So what were the objectives? Well, basically, of course, it was to assist the credit union transition from GAAP to IFRS, provide tools, information, and solutions tailored to the needs of credit unions. So it's important to underline here that a key objective of the project is not to ensure that credit unions are ready, but rather to provide them with the tools so that they, together with their auditors, can make themselves ready. One of the objectives is to minimize duplication of effort. Certainly on the financial instrument side, credit unions, once they shared notes with each other, were realizing that they were reinventing the wheel more than once. One of the objectives is to avoid expensive seminars and conferences. So let me illustrate. Back in December of 2007, when IFRS was still in its infancy on the radar of credit unions, I attended a seminar that was sponsored by one of the national accounting firms. And the cost for that seminar was $2,000. I counted 70 different credit union attendees in the room. If you do the math, 70 times $2,000 is $140,000. And a number of those people traveled distances to attend that seminar. You can create a lot of resources and training with that $140,000, and that would be specifically geared to the credit union environment. An objective is to leverage knowledge and resources, so use the skills that credit union people have and share them as much as possible, access expert advice, and for this project, the Canadian credit union system is using Deloitte & Touche, supplement but not replace the relationship with external auditors, and identify regulatory issues and coordinate solutions with the various regulatory authorities that regulate credit unions. The structure of our project is national in scope. So it was approved by Credit Union Central of Canada's board. It was sponsored by a formal committee that already existed in our system, our National Financial Policy Committee. And I think this is important. It's funded by assessments. So Credit Union Central of Canada and its activities are funded by annual assessments levied on the 7 centrals, which are then indirectly funded by credit unions. This national project is funded in the same way. It's not a user pay project. Therefore, credit unions do not have the option of opting in or opting out and paying or not paying. That meant that all of the resources could be committed ahead of time. We knew how much funding was available and could leverage that effectively. Also, there were not significant user pays that would discourage smaller credit unions from participating. All of the tools and resources are available equally to everyone. There was an advisory group created, and this advisory group consists of 23 individuals, a combination of people from credit unions and centrals. It was really important that this not be devolved or created by the central organizations in the absence of knowing the needs of credit unions. So there are small and large credit unions on that advisory group. And as we'll be seeing in a few minutes, there are 7 different technical work teams as well. The project sponsor is Canadian Central, the technical advisor is Deloitte & Touche, the project manager to handle the administrative work and the coordination is at one of our centrals, Central 1 Credit Union. Now I have a number of slides here that list a number of people's names and their organizations. This first one illustrates the 23 people who are part of the advisory group. As I mentioned, a combination of centrals, credit unions, large and small. 7 work teams, 1 on business combinations, 1 on employee benefits, 1 on financial instruments, property, plant and equipment, lease originations, loan loss provisioning, and securitizations. These work teams are different sizes, as you note. The size difference depends on the expected workload to address that subject, and quite frankly, the number of volunteers that we had, because we didn't want to exclude people. We wanted to ensure that those who wished to participate could, because one of the important components of the project is to build knowledge and capacity among the work team level participants. And a lot of that knowledge exchange is happening at the work team level. That knowledge exchange is happening then outside of the seminars, workshops, and webinars that are the formal part of our project. So what are the deliverables? What are the tools? We've created a website, and all of the webinars, the toolkits, announcements, the newsletters are lodged at that website. It's a password-protected website because we're jealous of the costs that have been incurred in this. We don't want them to be accessed generally by the public and other entities that might be converting to IFRS. So the access to this website is limited to Canadian credit unions, but also their auditors and their regulators. And we felt it was important that all of the auditors of credit unions and all the regulators of credit unions have access to all of these toolkits and information to maximize the information exchange. Back in June of 2008, there were 2 introductory webinars. Each of those attracted about 300 separate phone lines. On some of those phone lines, we had multiple participants. So there are 430 credit unions, so a high proportion were tuning into those initial webinars to get an idea of what was coming at them. Those webinars, of course, have been archived. They're available on the website as well and are being accessed subsequently by those who didn't participate at the time. Knowing that communication with boards and audit committees was important, a PowerPoint presentation package was put together that was intended to be used by the staff at credit unions to introduce the concepts and the key points to their boards and audit committees. There was a diagnostic toolkit which was put together with 9 accompanying workshops that took place across the country. Those workshops were in-person workshops. People traveled to those, and they were introduced to the diagnostic toolkit, which was intended to help credit unions identify the issues that will be important to their own credit union. Because there was some financial statement disclosure required for 2008, there were some sample templates that were provided as well. And newsletters are being produced on a continual basis. To date, there have been 8 newsletters created. In 2009, there were subsequent workshops, 7 of them, to introduce the implementation planning toolkit. And that toolkit helps to formalize project plans at credit unions. It provides templates of the types of things that will help to organize their staff, communicate with each other, and prioritize. In addition, there are separate toolkits prepared by each of the work teams, and a 2-hour webinar has accompanied the introduction of each of those toolkits. Loan loss provisioning, business combinations, financial instruments, plant, property, and equipment, employee benefits, leasing originations, and securitizations. Those are the 7 key subjects that that required information exchange. There are, of course, other topics that credit unions need to know about that would have less impact than these top 7. We are leaving those to credit unions and their auditors to learn about themselves. They can fill in those gaps on those lesser subjects. Still to come, templates for financial statement note disclosure for 2009 will be released in November. We are in discussions now with our stakeholders about the continuing webinars that would occur in 2010. We feel that by November of 2009, we will have created the tools for credit unions to use. But we think that there's a role for continual sharing of information that might take place through webinars. There will be future newsletters, and we are still working with regulators to understand what their requirements will be in reaction to IFRS. We're expecting further word from them later this year and into next year, and that also will require some work on the national project side to keep abreast of that. Where are credit unions now on the project? Well, this is a work in progress. Knowing that the first financial statements don't need to be prepared until 2011, of course, causes some not to fully engage in the project. So there are different levels of engagement. There's good attendance at webinars and workshops. By the way, at most of our webinars, we have between 150 and 200 lines engaged. But good attendance and information receiving doesn't necessarily mean that credit unions are using the tools yet. We find that the larger credit unions, the ones that are more complex, are more fully engaged at this point. They are the ones that perhaps will need more lead time. We're finding that the smaller credit unions are less engaged, but feel that they do have time between now and 2011 to become ready for this. We are still struggling, however, with the different capacities of credit unions to assimilate all of the information.
Unmuted.
Use it. Smaller credit unions with small accounting staff may find that they are not themselves going to be using the tools fully, but they will be relying more heavily on their external auditors to help them get ready for IFRS. I have 2 more slides here, but I'm conscious of time. The last 2 slides refer to the steps for building an IFRS implementation plan at the credit union level, and the last slide refers to the critical success factors at a credit union. And I think I'll let you go through those slides yourselves, or we can address them during the question period. So that concludes my remarks, David.
Great. Thank you very much, Gary. It's quite evident that a lot of effort and time has been put into this within Canada, and why we chose you this morning to go ahead and be one of our lead presenters, because so much thought and activity has already occurred here. One thing that struck me was the comment that credit unions didn't want to have to go through this independently. And that is exactly part of the reason for holding this session today. At many credit unions at a national level and regulators, it's that same feeling that we don't want either regulators or credit union systems themselves to have to go through it independently. So thank you for sharing that. Following the presentation by Eleonora, you'll hear a very different perspective in that within Macedonia, there is really a single credit union that operates at a national level. It's a much smaller system, but it's also much more integrated than what was discussed in Canada, so we wanted to provide some different perspectives on that. So we'll turn it over to you now, Ellie.
Thank you, Dave. Well, my name is Eleonora Zgunjanin Petrovic, or shortly Eli, and I'm CEO of Macedonia. And Macedonia, just to make sure that we understand, we are a really small country, bordering Greece, Albania, as you can see from the slides. The result of this introduction is just to get you a feeling how small country we are, and normally according to that how small is our movement. But that oppositely will encourage, I think, worldwide most of the movement that if we did it in implementation, and honestly speaking, we were the first credit union movement that we did implementing international standards, then probably worldwide most of the credit union movements will do much easier than us. As you can see, we are around 2 million people, and with a very high level of unemployment. The financial system, as exclusively deposit-taking system, it's set up for the international accounting standards. Practically all 14 banks internationally owned, 4 domestic banks, 9 saving house, and our institution were platform for this type of the implementation of international accounting standards. While I'm talking about this quite difficult subject, especially for the small institution as ours, I insert few pictures so that you can enjoy the beauty of Macedonia. The further, I would like to talk about the things that are around here so we can make sure that you get a feeling how our financial system is structured. First, our institution practically works only the savings and lending to the physical persons, exclusively our members, and we are not allowed to accept foreign savings. When I mean foreign, that means like in euros, no matter that 70% of our savings in the country are in the foreign currency. Macedonia was part of the pyramid scheme, and also we have quite restricted right for saving, attracting saving. Practically we are allowed to attract the most double from our institutional capital in the savings. We are under the new banking law with the special sub-directives that apply for our operation. We don't have exception of any taxes, including the income tax, and as you were all aware, we get a quite good effect from the global crisis. Just small info so you can get a feeling how small we are. and we have over 8,000 members all over the country. With the system is structured that we have one central office, then we have 6 branches with a different field of membership on the geographical aspect divided, 2 teller points, 4 access sales points, 25 number of employees, and around $6 million in dollars in assets. And saying all this, the structure of our implementation was beginning in December 2007, when the central bank, which is our regulator, set up the period for starting the implementation of International Accounting Standard. Period that was given, it was around 2 years, because this December we will practically the first time reporting with the International Accounting Standards. Prior to that, the January 2008, we have been having like a startup information and financial disclosure for all the changes that we need to make according to the International Accounting Standards. As you can see from this slide, practically the standards that we implement are all these that are presented on these slides, but with the that are structured as of January 1st, 2008. What we were not still compliant, and we don't need as an institution, as a credit union type, we don't need to apply according to the employment benefits, standard for employment benefits, practically all that are in black. The reason is that were not applicable for our institution. I will try to refer further in my talkings the word standards, because I know how it is difficult with acronyms, so I will try to make sure that everything that I say will be applied as a standard. Also the same, what was applicable with black, it's not applicable for us, but with red it was applicable for our institution. Completely not applicable, so practically we didn't even incorporate in our methodology for developing the implementation of international standards was all these standards that are completely not accepted, not only for our institution but also for whole banking industry that were applying in the same time. Saying all this, I will be talking a little bit more operational, saying from the aspect where we were having the biggest challenges. And the reason of that is, as I said, we didn't have, honestly speaking, luxury to have someone to guidelines us, because the main reason was we were the only institution, and the only support that we got, it was by the special seminar that was organized for us and for the banks, but still there was a lot of differences between us and the banks that created extra additional support and a lot of questions written from the different type of regulators and institutions to make sure that we can apply appropriately international accounting standards. First of all, I'm assuming for the worldwide movement, the readiness of introducing effective interest rates. So practically for the worldwide countries that already implemented effective interest rates as a part of the consumer protection, in that case they are, honestly speaking, halfway of the solving the problem with the composition of effective interest rates according to the standard 39. But for the others that are not, so these are the most of the time that we spend to make sure what is applicable, what is not applicable. The second issue is the income and expenses of the fees and commission, to make sure that we are applying with the standard 18 and 39. And at the end, I will say worldwide famous impairments of the loans, I will just refer here as a loans, considering that our institution has only the loans as something that was evaluated in our assets. Well, what is the difficulties is that the effective interest rate is the rate that is calculated from the exact but discounted future cash flow. That was expected in the period of the financial instrument, which in our case we'll talk about the loan. Practically the goal of this is to make sure what is the value of the money that will be futurely repaid by our members. The question always pops in during the million consultations that we have, why we need that effective interest rate. Well, the reason was that we wanted also to make sure that there is a true revenue from the interest, and as the previous presenters said, to be presented and measured appropriately and true in the financial statements. Also, the calculation of the effective interest rates is consisted of all paid or accepted fees. So the biggest tricky question is to be paid, then transitional cost, and also everything else that can be set up as expected future cash flows, what might be paid. So the income from the interest is set up in exact period of time, which will normally affect on our balance sheet. Now practically to make sure that you are good with the calculation of effective interest rate was to make sure which and what is consist or what is not consist in the calculation or in the composition of the effective interest rates. So in our case, we make sure that yes, everything that goes with the loan application fee, like a loan processing fee, fee for opening savings account in the moment of like a precondition for getting a loan, are applicable, and they should be consist of the effective interest rates. What you are not required, as we agree with our regulators, it's the collateral appraisal fee, collection fee, fee for further loan management. So everything that in that moment when the loan is disbursed, it's not known and cannot be predicted as a future paid by our members. The second issue that we were facing, as I mentioned, is to make sure that what is expenses and when is expense or income. So therefore, we can say that the revenue from the interest shall be recognized only normally using effective interest method, but when there is a probability for the economic use of each of the transactions, and also the precondition is to have inflow or outflow for that institution, and furthermore to have a proof for realistic measure of that income. So we set up here some examples, like in the way that there is example for in the future, income for the future will be everything that is coming from the effective interest rates, like loan applications fee for opening the account. And the income statement will be directly affected in the period when the expenses or income will come in the today's income statement. For example, like later on, the collateral appraisal fees. Therefore, what we need to make sure is what will be and what will not be income and expense in the certain period of time. Other fees that are not measurable will be directly, so whatever we think that is not in the composition of the effective interest rate, it will be directly recorded as an income statement. And now at the end, I will just make sure that what was the most difficult for us was the impairments of the loans. Why? Because there are two ways for impairments: assets that are carried as amortization costs, and which we agree that will be loans, and the assets that will be carried as a fair value. So practically, as the professor before mentioned, it will be, for us in our case, that was the securities. What I would like to make sure that I will just give you the slides for the further readings, but the biggest issue that we were facing is practically how to make this happen, practically how to make sure that the loans are carried as and calculated their impairments as amortized cost. So therefore, the precondition was to make sure that there are impairment losses of some events, and how to make sure that there are events. We set up the existing criteria, that there is a delinquency in the payments, that the cash flow is questionable, future cash flow, and then there are other preconditions that we already structured to make sure that there are events that will show the further need of the impairment. And the most difficult for us was the last one in the red, the value of the collateral, because here in the country there are no independent source where you can get the information of the value of the collateral, which is the precondition for the use in the calculation of the impairments in the standards, because it cannot be how much we appraisal the collateral, but we need international recognized value of that collateral. Furthermore, there is what I would like to recommend to everybody is to make sure that you can make groups, that the standards allows that, and if there are possibility to structure some of your assets in group, some of your loans in group, make sure that you do that. And I'm really gladly recommending this, no matter that it's quite complicated process in the beginning, but later on that will be really good, because we did that. And why? Because we have so many loans that are small, and if you need to make discount cash flow for each that loans that is completely not, how they say, appropriate from the viewpoint of the economic justification. So the further I would like to just to pinpoint about as the professor said, if you have in the impairments, there are differences that you can revise. What was one income, what was one expense can be income, and versus. So the result of that you can change that during the period of the year. And about the fair value, we know that the only assets that we hold that probably the result of the fair value is the securities. So for the most developed international market, that's easy to make sure what is the value. Again, for our markets where there are no recognition about the fair value in the exact moment, we need to make sure that is what is on the existing market, but still we have only treasury bonds and that type of securities that probably will be not changing the value so much. And what I would like to say at the end is about the timetable. We had been having the first 6 months writing new procedures and new policies. We have in-house IT system, but we work 3 months, 24 hours on our IT system, and that because when we wrote the policies and then we change something in the IT, then it's not like that. Then again you go in one imaginal circle. Then unmuted. And that was, I just wanted also, as Mr. Gary said, that the problem, it's not only accounting, and it's very, very important that you get everybody involved and all of the employees, no matter is it that tailor point, but they need to do that each of their transactions that might be changing the information within the system. We have 3 months of the testing of our information system, and also now we have 12 months daily monitoring of implementation of the system. Also, we want to make sure that there are other issues like depreciation of fixed assets that we change. The big issue is membership deposit. That is that if it's calculated as a fee, if it's calculated as a savings, that's quite good impact on the effective interest rate. And normally, as I mentioned before, the issue about the value of the collateral. Honestly speaking, I would like to just pinpoint that it is what is not possible during the implementation. It is really not possible to be done manually. It is technically not possible to be done without at least 3 employees, 24 hours working on the issue of the implementation. The period cannot be less than 6 months, no matter how much and how many transactions you have, and it's not possible to be done without external support. I'm really glad hearing that there are a lot of national associations that were involved during this webinar, because at the end it's much easier for the credit unions that have someone through the national association system, like the presentation that Credit Union Central of Canada was having. Honestly speaking, to be honest, if we had the support as I saw now from the Credit Union Central of Canada, probably we will be having less sleepless nights, and at least we will implement the system. And at the end, I would like to say a special thank you for inviting me to share our knowledge, and feel free to call me or write me, and we can share whatever we did till now. Thank you.
Great. Thank you so much, Ellie, for that presentation and showing, as we selected these presenters, to demonstrate that the scale and scope of the organizations that have to implement this is wide, but yet it is possible to do it among various size institutions. So thank you for that excellent presentation, and hopefully you will make less sleepless night or fewer sleepless nights for others around the world, Ellie, after sharing with us today. We're now at the point where we're going to open it up for questions, and there are 2 different ways for people to ask questions during this part of it. As you'll see on your drop-down box, there is an area that says questions, which you can select, and there is also another area where it indicates chat. You can go ahead and if you click on that bar, it expands and you can submit questions or chat. Before we do that, I did want to see if Andy Papaura, who I mentioned is the chair of the International Credit Union Regulators Network, if he would like to make any comments at this time, assuming that your microphone is working there, Andy. Andy, did you have any comments you wanted to make this morning on it? Hearing none, or possibly a technical issue. Let me check with Lily if we have other questions at this point. I know that I have a question for Gary, and that is, to date, Gary, trying to understand if a credit union system were to just be starting this process of thinking about moving towards IFRS, what do you see as the key steps of moving along that process?
Well, thanks, Dave. I think a key step for a credit union system is identifying what they can do together in the form of a project that would leverage resources. That startup discussion among various stakeholders takes a long time. It certainly took us quite a few meetings to iron out the extent of our project and how much we wanted to be involved together versus how much that we wished to do on our own at at separate credit unions. So there's a happy medium there. For individual credit unions, the lead time will vary quite a bit depending on the nature of their activities. Some are involved in very complex transactions and others much more straightforward. I think that one should count on a minimum of 18 months to get ready for IFRS if it's a fairly complex credit union. Others may get away with waiting until the last minute and using some Excel spreadsheets to pull together some amounts, but you really have to assume that your staff are going to need a considerable number of hours to assimilate the information, to access the information, learn about it, and then implement.
Thank you, Gary. You know, having your foresight from a large credit union system is I think key to that. I also had a question for you, Holly, and that is for many of us in the credit union sector, this is all brand new. We feel like we're conquering new territory, if you will. What you heard this morning, how similar or different is this from what you're seeing other kinds of businesses and other kinds of industries going through? Are there things that you think as credit unions that we are missing or could do more of that you're seeing in other industries?
I think the fundamental concerns are the same. I think Gary's slide that indicated the process is not just about accounting, but embraces other components of an organization, and the contracting that takes place in the organization is true of all entities, but the devils are in the details. So fundamentally, each organization that adopts international financial reporting standards has a different set of contracts that they have to adhere to, both explicit and implicit. And as a consequence, the application of IFRS will differ in that there will be some standards more important relative to others. However, that being said, a key concern of the ISB, the board, is that an entity adopts them as a whole. So to the extent a credit union might, and a member collection of credit unions might have some standards that aren't as pertinent or they feel aren't as relevant, rank ordering the important standards, as actually Gary suggested they had done in Canada, is an extremely important way to think about organizing the transition. And what that means then is different industries will prioritize different standards and focus on those standards first in an attempt to have consistent implementation. But everyone is facing it, and the struggles are common across all. The lead time is significant.
Thank you. That seems to be something that everyone stressed this morning, that it does take some lead time for this. One other item that became evident for me listening to the presentations this morning was also how does a credit union system in a country recognize when this is happening to them? And I stress the words "to them" because at times it is external that this is occurring, or how do even regulators at times, of which we have many on the line, check and understand, okay, when is this happening? How much discretion do we have as to when we begin this process? Gary made it sound like, as did Ellie, that there were some external decisions made by their National Accounting Standards Board, by their central banks, etc., that said this is when it's happening. Is there a resource as to when you can, where you can go and look and find that out?
That's an an excellent question. As far as I know, there is not. There isn't a common clearinghouse that's monitoring the country-specific adoption and implementation of IFRS. There is, the ISB follows it and seeks input into their documents and their records, but they attempted this 10 or 15 years ago, and it created a lot of controversy because then there was an implicit assumption that the ISB was monitoring it, which they are not.
Okay.
However, there are websites. So, for example, I cited one website. It's IS Plus.
Right.
It's supported by Deloitte, and they do a good job of, again, keeping track of developments on IFRS acceptance and implementation, but they still aren't the authoritative experts. I suggest that your membership bodies go directly to their own country level accounting standard organizations or regulators to seek clarification, because there isn't a clearinghouse on the net or globally, sadly enough.
Great, thank you. Some of this reminds me of year 2000 preparations, long lead time, except it was very clear then as to when it was happening. And it was a clear, obviously, common date globally. And really for many systems kind of digging into issues for them. I know that I think Andy Papower had sent a message back that he might have some comments, but we are having a technical problem with him. So Andy, if you want to send an email or so related to that we could go ahead and maybe connect that way. Other questions that we have, Lily, at this point? Okay. Hearing none at this point, and we're right about on the hour. I'll ask our presenters if they have any final observations or comments before we wrap it up. Ellie, I'll start with you. We'll go in reverse. Any final thoughts or comments?
No, just I would like to say that it's something that is matter of time that will be done, and it's good that we are starting early as a movement worldwide to be prepared, and considering that there are time for the period of implementation, I'm sure that we will be very successful as a movement.
Great. And Gary, did you have any observations or thoughts on the other presentations that you wanted to share with us as we wrap up?
Not specifically on the other presentations, but just a comment that we're in the midst of our preparations to make the conversion. We look forward to sharing with you the results because, of course, you can create wonderful tools, a great bank of information, but unless it's in a usable form that can be easily accessed and used by credit unions, you haven't accomplished your goals. So I'd be quite interested in reporting back to you at some point in the future just how effective we feel the national project was in implementing IFRS. Again, a thank you to WOCCU for putting this on today.
Great. And Holly?
I too would like to thank you for inviting me and encourage all to keep an open mindset about the need for financial education. At times, it may seem quite burdensome. The demands by auditors, regulators, you can question, well, what's the benefit of all this? But I do really believe that that process is an important process, and all the parties to it play an important role that ultimately culminate in information that is powerful and is useful for growth. So to the extent that you can keep an open mind and embrace the standards, in the end, it will hopefully promote growth within your organization. Thank you.
Okay. And we had on a separate line Annie Papawra, who indicated that he'd like to thank World Council and on behalf of regulators for organizing this. So thank you for those comments, Andy, and sorry we had trouble connecting with you. What I would like to mention on behalf of World Council to those connected today is that first, as I mentioned, we did record the session. We will have all of these presentations on our website, and following today we'll send you a link to that so you can go back and at your leisure take a look at those presentations again. I know that we went through them quickly. There was a lot of information contained in them, but they will be on our website for your information. And that we will look to you all for information about whether or not you'd like additional webinars and discussions on this topic for World Council to host. This is the first one that we've had on this topic. Globally, we've done some more of this directly with regulators at some of their forums. But we certainly recognize and saw in the presentations today the value of sharing information across jurisdictions and understanding what's going on. And we will look to both the regulators and our members for guidance as to if you'd like to see more on IFRS or other topics similar to this. I will leave it there and thank everyone for connecting in at odd hours, staying late for work, connecting from home, or coming into the office so early this morning. So thank you very much, and I hope everyone has a good rest of their day. Goodbye.
Thank you. Thank you, Dave.